So there has always been a concern for Palantir, right, with regards to their share-based compensation. So the argument is that since they DPO, okay, they have always been quite heavy on the share-based compensation, and it took up quite a portion of their total revenue. So shareholders, the bearish views is always to say that they always give a lot of share-based compensation, and they will destroy the shareholder value, and they say it's not good, all right, in terms of for the long term. But I tend to like to give to a different view, right, regards to this, because you must understand how the US market works, okay, and especially the tech companies, right? A lot of the employees there, they like to be rewarded based on shares, okay, and as you know, the tech environment is very, very competitive. And especially for a company like Palantir, with the product, okay, and the services that they want to provide, they really need the top talents. Okay, they really need a very good people, okay, good employees and talents, okay, to create the product, okay, that they have. Yeah. So in order to attract these talents, all right, from all the other top tech companies, as usual, like Amazon, Meta, Google, you know, they need to offer them shares, okay, in order to attract talent, right? So this is one of the cultures that we first need to understand. But of course, I don't fully support if, let's say, they give a lot of share-based compensation. Okay, and they give share-based compensation, and if they never get the ROI, okay, and revenue never increase, then it's a problem. Yeah. So one interesting chart, okay, that I've already created for you guys to take a look is this. Now, to see, okay, whether this share-based compensation is good or not, okay, I teach you guys, you all can compare it, okay, with the total revenue and see whether the trend is going down. So if you see at the share-based compensation, I won't deny that, the share, okay, has always been a lot. Okay, total SBC here, share-based compensation, right? Okay, is maybe increased, all right, or it's quite a lot if you look at it, right? It's like 114 million. Oh my God, one in one quarter, right? Okay, but you see, you can see that since last time, okay, it took around 33% of the total revenue. But as time goes by, every single quarter, you can see it's on a very good trend. It's going down every single quarter. Yeah, it's going down every single quarter. So that's why you can see that at least the management, they are aware of this, all right, and then they won't destroy the shareholder value lah. Yeah. So for now, okay, Palantir is still on a very growing phase. They are still creating products, and they still need to take market share. Yeah. So for now, all right, I'm quite okay with it. Because you see, by awarding the share-based compensation, right, do they give results? This is the most important thing. And I think in my previous video, I shared with you guys, they grow their revenue, a lot. Okay. And then not only that, okay, they also get a lot of US commercial customers, accelerating growth. I showed you all last time. Yeah. They grow from 35. This is when the AIP, they created the AIP product, and then they do the AIP bootcamp, and they accelerated their US commercial customers. And in total, they're also accelerating. So the idea here is I want to educate, as shareholders, you cannot just look at it at a very small, narrow view, or giving share-based compensation means diluting the shareholders is very bad. No, you cannot think like that. Because if you want a company to be very strong, you want them to give the best of the best products. You want them, to be better than other competitors. And you must attract talents. Okay. And to attract talents, you need to reward them. Yeah, you should start to think like an owner, the owner of a business. If I want to achieve this, what I should do. Okay, we cannot think very narrowly, as a shareholder only. I don't want to give share-based compensation. I want to give low salary, and yet I want to win market share. I want them to continue to grow fast. You cannot think like that. Yeah. So as of now, all right, I think they are quite okay with the share-based compensation, and it's going good to keep on monitoring them. It's going downtrend. And I don't think that's the destroying shareholder value. Why? Because if you can see on top here, all right, and not here, here, okay, the per share value in terms of revenue, all right, there's no decline. Okay, as you can, in fact, you can see for every single quarter, they are increasing. Okay, of course, I would love them to increase at a much faster rate, but how to say, they didn't increase, okay, as much because there's still some form of share dilution. Yeah. So of course, we do hope they reach at some point, okay, when they grow to a bigger size already, then they will stop, okay, or perhaps offer a little bit, okay, of the share-based compensation as opposed to their revenue. Maybe I do not know. Okay, depends on their plan. Okay, like for example, this share-based compensation, okay, let's say 5 years down the road, or maybe 10 years later, from 19, maybe go down to 15, go down to 10. All right, as time goes by, the revenue accelerates, share-based compensation dilution go down already, then we may see the acceleration on the revenue per share here. Yeah, but as of now, there's no destroy in shareholder value. It will be very bad if, let's say, yes, the revenue is growing, but the share-based compensation is so much that it destroys, okay, or reduces the value of the share. But as of now, okay, as we monitor, I think it's not bad. I think it's not bad, okay? And one thing to take note, okay, from their recent earnings, and yes, okay, the CFO already told us lah, yeah, that they expect increased expenses. Why? Because they are saying AIP bootcamp is working very well, so they need to invest. Maybe they will get new engineers or new salesperson, all right, and of course they need to continue to reward them. As long as they can offer us accelerating growth, getting new customers, growing the revenue, I think it's justified. Yeah, because they currently have to meet the current huge demand. Okay, because this quarter they give us some form of visibility for the next few quarters already. Yeah, so if I can read here, given our conviction in the US business, coupled with the margin expansion, we intend to boost investment resources already, including AIP, and of course they are now focusing on the defense. So we expect expenses to ramp up. So this is a good thing, to be honest, because they are investing back in the business. But one thing, of course, if you are worrying on, in case they become losses again or what, don't worry, because the CFO is aware. The CFO is aware, okay? Remain focused on calibrating the expense growth below the revenue growth, so that they can continue to show get profitability lah. All right. So I hope this short video will educate a bit on you guys, that share-based compensation, whether good or bad, you really need to dig deeper, all right, and see how it really works. And as long as the usage of the share-based compensation is good, then we have no issue with it. All right. So thanks again for watching, guys. Yeah.